Hello everybody, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will contemplate trend following strategy. I would say it is one of the trend following strategies that's the most important building block of managed futures funds or CTA funds, and it's momentum or trend to your futures. We will explain why it's there and why we can relatively easily trade this effect and this anomaly. Trend following and momentum strategies are quite popular. We have over 100 of them in our database. You can easily find them by using the keyword trend following, and you can screen them in our database in a screener.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
So why there is a trend in 2-year futures and why it's so easy to profit out of it. So the 2-year futures are very, very sensitive to movements of the monetary policy. Monetary policy is set by Federal Open Market Committee, so by the Fed, on their meetings, which are 8 times a year. Now, most of the people think that, the Fed makes decision somehow arbitrary, but it's not true. They follow strict rules and they are quite predictable. So what does it mean is that if the Fed decides that it's time to start cutting, they will cut interest rates for a longer period of time. So what does it mean is that they do not change the direction from meeting to meeting. It's not that the Fed will cut the rates, then they will increase the rates, then it will increase, cut, increase, or something like that. So it's not going randomly. So usually how does it work like is that there is a long period of rates when the rates are going up, the Fed is raising the rates meeting after meeting, or at least is not changing the rates at all. So it's not touching the rate. And then after the inflation is finished, so the battle with the inflation is won, the Fed decides that that's the good time to start decreasing the rates because we are choking the economy. They start decreasing rates. Once again, they decrease rates, decrease, or at least they do not increase the rates. So they leave the rates as they are. And these long trends, they cause trends in 2-year futures because they are very, very sensitive to interest rates on the short end of the yield curve. There are a lot of the papers that are discussing this here in the background. You can go and read all of the papers. They basically, all of the papers that show that yes, there is really a slow moving trend between a policy regime. And we can use 2-year futures for that and we can trade them. And it's not very good idea to trade that using the 10-year or 40-year futures because they are already sensitive to something different, to inflation and inflation expectation, etc., etc. But if you use very short-term futures like 2-year futures prices, you can find interesting trading strategy. However, if you would like to backtest this strategy, it is very important to have the future price series that's correctly rolled because futures expire every 3 months or every month, it depends on the future, and there are gaps when the futures expire. You can see that in the picture. If you would like to backtest this strategy, you need to have a correct rolled data set. How to do the correct rolling, what is the problem with spliced futures, etc. It's in the independent article which was written by us 7 years ago, but it's still valid, so I will include also the link to this article into the description of the video. So check this out before you will start backtesting on your own onto your futures. So we have a correctly rolled future series, continuous future construction. Here you can see how to do that. Let's take a look on the benchmark. So the benchmark is the price performance of the futures themselves. So here we have a chart starting in 1991 or something like that. So it's over the last 45 years. So the performance was not something extraordinary. So the yearly performance of the 2-year futures were 0.42%. So this is the performance when you hold the 2-year futures and roll them on every expiration and buy the new futures, etc., etc. So you always roll the portfolio. However, they have very low volatility, only 0.8%, and Sharpe ratio is 0.52. And small maximum drawdown, just -5%. Small performance, but small risk. So what does it mean is that you can leverage this position significantly. Like 10 to 1 is not uncommon. So it's very easy to leverage this position because those futures are not very risky, not very volatile. And this is what happens in CTA funds in managed futures. So significant part of the positions that they have is in those futures because they are easy to leverage. They do not require significant margin and they are easy to predict. That's the reason. And a significant part of the outperformance or performance of the CTA managed future funds comes from just this strategy. I would say like 30 to 40%. Okay, so what is the signal construction? So let's take a look. You can have a trend following signal using the rate of change, so the classical momentum, and then we will check out how does it work if you use some moving average or whatever. I'm I'm not saying that those two models are the best ones, so the simple rate of change or simple momentum or simple moving average. You can try different, more sophisticated approaches, but at the end, what you are trying to harvest is the predictability of the Fed. Once the Fed starts the cutting, the Fed will continue and cut for 2-3 years. And the same is for increasing the rates. Okay, so you can go long, you can go short, you can go long short, and you can use rate of change on moving average. So here are the findings. Firstly, we tried long only rate of change to global momentum from 1 month to 24 months. Let's take a look at what is the improvement. So the Sharpe ratio is 0.5 and Kalmar ratio 0.09, let's say, and performance is 0.4%. Now, just using the momentum overlay, our performance is the best when we are using 9 to 12 month period. Sharpe ratio increases from 0.5 to 0.8, which is a 60% increase in the Sharpe ratio. On maximum drawdown is minus 1.5% instead of minus 5, which is a significant improvement. And Kalmar ratio is like 4 times better. From 0.08, we have 0.4748, which is significantly better. By using the momentum overlay, we can improve the performance of this equity curve just following the trend. That's all. When we short, what happens? In the last 35 years, most of the time, the Fed was cutting the rates, and only in the last 3 to 5 years, there was a significant increase in the rates that was for a longer period of the time. Now, how it will look like in the future, I would say that there will be more cases like this. In the 70s and 80s, it was like this. So you didn't have just few long trends in the cutting of the rates. There are periods of the increasing of the rates. In this case, if those periods will come back and the next 20 years will look like last 5 to 10 years, then it will make sense to have also the short side or short the futures. Otherwise, it doesn't make sense shorting. But the best period, once again, for shorting is on 9-month and 12-month period. And if we combine a long and short side on the 9 and 12-month period using the momentum, we increase the performance from 0.4 to 0.65%. The maximum drawdown is still around 2%, and we have a nice Kalmar ratio. And we have like a strategy, the green one and the blue one, which has very low correlation to equity market. I mean, like zero or even the negative correlation to equity market. So the numbers look small, but we can very, very easily leverage this strategy. So by 5 to 1 or 10 to 1. We can use the SMA, so we can use the simple moving average, and the numbers are plus or minus the same. So here are the long only, here is the short only, and here is the long short. Once again, the best period is 12-month period. Once again, the numbers are approximately the same. So around 2% drawdown, 0.6% performance, volatility 0.8, so Sharpe ratio 0.8, which is absolutely great, and Kalmar ratio 0.3. So this is a very easy to leverage trading system, which is one of the cornerstones of CTA or momentum or managed future funds. I would say like 30% definitely of the performance of the funds comes from those movements in the short yields, and they are harvesting these movements. I mean, not just on US 2-year futures, but they are using also the futures on Japanese market, on European market, etc., etc. So they are diversified, but still they are harvesting the performance and the trends that are easily predictable on the short end. So I hope that you liked this strategy. I hope that you like this article. If you are interested, read more about how the trading strategies are built. Visit our blog, visit our screener. In our screener, we have over 1,200 strategies described, and give us the like, subscribe to our channel. And I hope that you will join me in the next video. Thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.